And the next one on the list is one offered by the CoreShares group. Remember, that's the Grindrod Bank-linked crowd. International Property Portfolio. The code here is GLPROP.
Well done.
Not bad, not bad. Getting there.
I left out a few points there,
Yes, you
I must
did.
say.
I know, exactly.
I was sort of glossing here or there.
Complicated.
But you got the most important bits in there, because I think what is really important here is that it's global and it's property. And that says it all for us, really. So what you're looking at in this investment is it tracks an S&P index, the S&P Global Property Top 40 Index. So it picks up the 40 largest global property companies, but there's a couple of criteria. Developed market, it has to be. It has to have paid a dividend in the last year, so you can't just be big but not pay dividends. You also have to have sufficient liquidity, and then they cap it at 10%. So it's a modified market cap weighting. But I think the important thing for me here is to look at that global footprint and say, where am I buying property exposure through this ETF? And about 56% of it, over half of it, is in the US. So it's a strong US bias that you've got here. And then also quite a strong bias to Asia. Now, bear in mind, I said
what
developed
property
markets.
are we talking about here?
So listed real estate companies, so REITs, real estate investment trusts. So you're dealing with listed property companies. So these are not direct properties that you're buying, but REITs. So they all, and REITs, bear in mind, they've got the criteria that the majority of the earnings that they generate, which comes from rental income, has to be paid out to investors. So this type of thing will always have a very good yield, a very high payout.
In essence, it's corporate office buildings and quite a lot of retail malls.
Quite a lot
as
of
well.
retail, so yes, it
And
is.
US, you said 56%
Yes,
US.
56% US, but then also quite a strong focus to Asia, Australia, Japan, and to some extent Hong Kong as well. So not China per se, because this is a developed market. So where it's listing and trading must be in a developed market. Why I like this as being complementary. Complementary to the South African property exposure that you can get is dominated by UK, Europe, South Africa, whereas by adding this, you now really truly get a global property footprint.
And that spike at the end there, that's the weakening rand, is
Indeed, indeed. And in fact, I actually want to point to two things there. You'll see that there was an initial spike late in March, and then it pulled back, apparently, and then the real run-up. That apparent pullback was when this ETF went ex-dividend. So what you're seeing there excludes the very big dividend that they will be paying now in April. And the beauty about this one is that it yields over 3%, close to 4%, in fact, in dollar terms. And therefore, once you add the currency to it, it's going to be a significant yielder. So just in terms of the current yield or dividend that they will be paying, it will be close to 4%. I'm hot on this one.
I think with the rand and the combination, I am a little worried about retail malls generally, but I think the quality here is right up at the top, so not too concerned.
And diversification being the name of the game. So we've got a 3 out of 4.